Hello, this is our state of the company and 3-year strategy presentation for My Pair Footwear, Industry 2, Company E. My name is Jonathan Renteria Torres.
My name is Derek Flores.
My name is Sean Gilbert.
I'm Austin Jedlowski.
I'm Joanna Sang.
We started out with a broad differentiation strategy. We hope that compared to other teams, we would supply a broad variety of styles for our customers to choose from. We wanted to produce a high quality product by using a large portion of superior materials at a competitive price. However, we realized after year 12 that this was not a feasible strategy for our market. At this time, we switched to a best cost strategy for internet and wholesale markets. But what truly allowed our company to be successful was our focus on the private label market. We were really aggressive in the private label segment to ensure that we sold up to the market share limit at a price that would give us the highest return without pricing ourselves out of the market.
Strategic Group Map, Year 11, North America Wholesale. We started out going for the best cost strategy, moderate number of models, average SKU rating, lower than average price. After year 11, whole price averaged $55.12. Ours was $51.79. SKU rating averaged 6.1. Ours was 6.0. Model availability averaged 338. Ours was 300. Industry leader was Team A. Higher than average price, 61. Lowest SKU rating, 4.2. Higher than average model availability, 446. EPS, 643. As we can see on the chart, we are centered with C and H. By overlapping with other competitors, we are spreading the full revenue we can gain.
Strategic Group Map, Year 14, North America Wholesale. So we started with a competitive strategy and switched to broad differentiation. We increased the number of models available. We went with an average SKU rating and also an average price. We noticed that our price was considerably lower than the competitors. After year 14, wholesale price averaged $62.22. Ours was $61.80. SKU rating averaged 5.9. Ours was slightly lower at 5.2. Model availability averaged 475. Ours was 498. Industry leader remains to be Team A, higher than average price at $64. The lowest SKU rating at 4.9, higher than average model availability with 500, and earnings per share was $6.99. Once again, we were just really we were kind of averaged with everyone else in the price and SKU rating here.
Joanna?
Sorry, I was on mute. In this slide, we will discuss the trends of our company's net revenues and how it relates to our overall strategy and responses to our competitors. In year 11, our net revenues were at $499 million. Our net revenues overall are fairly low compared to the rest of the industry due to many companies pursuing the same low price strategy. Because of that, in year 11 through year 14, we decided to pivot to a new strategy of producing a higher number of models with maximizing our private label revenues by increasing price while producing up to the potential maximum of 22.2%. As a result of this strategic pivot, we were able to increase our total revenues from $499 million in year 11 to $628 million in year 12, and $814 million in year 13, and $810 million in year 14, respectively. This was a 63% growth rate from year 11 to year 14. From there, we were able to continue growing our net revenues at a steady pace year over year, and we continue to put more resources and efforts into producing for private label segment, as we found many competitors that did not pursue the same route. In year 14, we decided to pivot once again to increase our internet and wholesale prices to compete with the industry average.
EPS, earnings per share. EPS for Team E jumped from 177 in year 11 to 595 in year 14. We did this by repurchasing stocks. Year 11, we repurchased 200 stocks at the price of $30.30. Year 12, we repurchased 446 stocks at the price of $19.35. Year 13, we did no repurchase stock to focus on other aspects of the company. Year 14, we repurchased 750 shares at $101.67. As net revenue increased, so did the earnings per share. This was due to the change in our company strategy. As we repurchased stock, there was less shares to divide earnings over. Derek?
Our stock price increased from $18.91 per share in year 11 to $113.74 per share in year 14. That's more than a 500% in growth. As our revenues increased, our earnings per share increased. This was due to the change in our company's competitive strategy. This also increased our stock price. Our stock price followed a similar trend as our earnings per share did. Looking at the graph, as you can see, our stock price went down from year 10 to year 12, then it significantly increased from year 12 to year 14. This resulted making changes to our private label operation that in return brought in more revenue, increasing our stock price. We will continue to focus on private label in hopes of continuing to increase our stock price.
For competitor analysis, we chose company D. They were the closest strategic competitor. They were closest in investor expectation score, best in industry score, and weighted average score. Company D had much more celebrity appeal, but the contracts are expiring soon. They were able to win several of the bids and obtain more celebrities than we were. Their wholesale price is much higher than ours. They have zero market share in the private label market, and they're offering free shipping on internet orders in all regions.
Forensics, checklist, EPS, definition, net income divided by number of shares of stock issued to stockholders. Drivers, net income from the income statement. The income statement will depend on segment revenue, which is internet, wholesale, and private label. Our exchange rate adjustments, operating cost from cost of pairs sold, warehouse expenses, marketing expenses, administrative expenses, our interest income and other incomes, our income tax netted at 30%. And also another driver is the shares of stock outstanding. Most important drivers for our team were to raise net income in the income statement We would be able to do this by increasing segment revenues, keeping an eye on exchange rate adjustment, decreasing operating costs, understand other incomes or expenses, and make sure that we keep an eye on also the income tax is 30% of pre-tax profit. Also repurchasing shares of stock.
Our company's return on equity is above the average for the industry sector. And we have maintained an average of 25% return on equity ratio compared to the industry average of 21% in year 11 through year 14, which means our management is above average at using the company's assets to create profits compared to the industry average. In year 14, our company's return on equity is at 31%, which implies that the company can produce 31 cents of profit per year for each dollar of equity. The return on equity is calculated using net income divided by average shareholders' equity. We also calculated the retention ratio of net income that is retained to grow the business. Rather than being paid out as dividend, our company's retention ratio is at 100%, which helps investors determine how much money our company is keeping to reinvest in the company's operations. Using the retained earning and the retention ratio, we further calculated the sustainable growth rate, which is the rate our company can grow without having to borrow money to finance that growth. We estimated the company's future growth rate, multiplying the return on equity by the company's retention ratio. Our company's estimate future growth rate is at 31% and is closely aligned with our industry leader and competitors for the years of 13 and year 14. Our most important drivers for the future years is to maintain a steady and above average return on equity compared to the industry average. And also maintain our current sustainable growth rates.
Forensic checklist stock price. Stock price definition is the current price that a share of stock is trading for on the market. Drivers include dividends growth, revenue, EPS growth, return on equity, credit rating, and stock repurchase. The most important drivers for Team E right now were continued EPS growth year over year, credit rating. Once the loan from year 12 is paid off, stock price will increase due to the decrease of debt to assets ratio. And the continued ability to repurchase stock will have a positive effect on the stock price.
Forensic checklist credit rating. The credit rating is an independent assessment of a company's credit worthiness in general terms, or with respect to particular debt or financial obligation. The drivers of the credit rating are the interest coverage ratio, the debt to assets ratio, and the default risk ratio. The interest coverage ratio is the annual operating profit divided by annual interest expense. The debt to assets ratio is total liabilities divided by total assets. And the default risk ratio is cash outflows from operations divided by the combined annual principal payments on all outstanding loans. The most important drivers for our team right now, our annual operating income continues to increase, and this increases our interest coverage ratio. In year 12, we had to take out a large loan. We took out a 5-year loan. This long-term bank loan is almost paid off. Every year we pay down this loan, our debt to assets ratio decreases. We plan for net profits to continue to increase. This, combined with decreasing annual principal payments, will increase the default risk ratio. Our goal is to continue to increase operating income and net profit while paying down the current loan and not having to take out any more loans.
Forensic checklist for image rating. The definition for image rating is the customer's perception of the company based on their interactions with the company. Some of the drivers for image rating are the global average branded SQ rating, the global average market share, the company's actions to display corporate citizenship, and the company's operations in a socially responsible manner over 4 to 5 years. Most important drivers for our team right now are to raise our branded SQ rating. We can do this by spending more on superior material, as well as increasing our enhanced styling and features. Another important driver for our team right now is to increase corporate social responsibility and citizenship initiatives. We can do this by improving working conditions, like buying additional safety equipment and improving lighting and ventilation. We can also invest more into energy efficiency initiatives. Looking at the table, you can see that our North America SQ rating from year 11 to year 12 increased from 6.0 to 6.3, and our image rating went from 72 to 78. Then our SQ rating from year 12 to year 14 went from 6.3 to 5.2, which could be one reason our image rating dropped from 78 to 76.
In this slide, we will discuss our company's future strategic plan. We were able to position ourselves well in year 13 and year 14 compared to our competitors in the industry, and ended up on top 3 in the industry. Looking forward, we intend to maintain a lead in our competitive edge and surpass over our biggest competitor, Team D, by doing the following. We will continue to analyze the industry, evaluate the market conditions, and pivot our strategy as needed. We would continue to execute our lower pricing strategy, but with a higher quality rating. In year 14, our internet retail price was $89 and wholesale price was $61.80, while Team D had an internet retail price of $93.50 and wholesale price of $67. We will continue to pursue higher SQ rating by improving the following areas: adding new features and styling to our footwear models, increase use of superior materials, invest more in the Six Sigma quality control programs and efforts, and also increase investment to train workers. In year 14, our SQ rating was 5.2, while Team D had a SQ rating of 4.9. Also, we had a brand reputations of 81, while Team D had 67 only. We would like to invest more in our search engine, brand advertising, celebrity appeal partnerships to boost our brand image and customer loyalty. By doing these, we're able to grow our overall demand and market shares. We will continue to compete aggressively in the private label sector. In year 14, we had a 17.5% of market share in the private label sector, while Team D had 0 market share in the private label sector.
Our 3-year competitive strategy for years 16 and 17 is to continue to increase segment revenues in all segments. We've been very strong in the private label and will continue to be a strong competitor in this area while staying true to our internet and wholesale market strategies. We will decrease our operating costs by only replacing needed equipment, selling unused equipment, and switching our production to Latin America and Asia Pacific. We will continue to maintain a steady return on equity. We know that year 16 will be rough. A lot of our equipment will have to be replaced. However, we hope to continue to maintain sustainable growth rates without having to take out another loan to finance this equipment purchase. Our annual operating income will continue to increase, and this will increase our interest coverage ratio. We will pay off our long-term bank loan, and this will decrease our debt to assets ratio. We will increase our SQ rate ratio by spending more on superior materials. We will continue to increase our earnings per share to make our shareholders happy, as this will increase the value of stock. We will also continue to repurchase stock, which will drive the price of our stock up, increasing earnings per share as there are less shares to divide the earnings over.
As for lessons learned, we will continue to aggressively compete in the private label segment by continuing to offer pairs up to the market share limitation of 22.2%. As for our wholesale and internet pricing, we will continue to increase them while remaining under the average price. We will also continue to aggressively compete to get celebrity contracts. We will also continue to repurchase stock to increase our earnings per share. It is also important for us to have enough profit to carry over into next year for capital purchases and to cover inventory not produced. This concludes my Pair Footwear's presentation for the state of the company and the 3-year strategy. Thank you for your time.